So Dilly,
Oh my God.
am I am I doing better? Am I doing better or worse than my music picks?
No, I like the energy. I really like the energy, but George, how the hell did you find that song?
It's one of my favorite songs.
Wait,
I don't know what.
really?
I know it's Pitbull, and I don't know all this stuff. And man, the chicks
You
he hangs
listen to
out.
Pitbull.
Well, I'm not a Pitbull fan, but I love the
Okay.
energy. I love the energy of that song.
Yeah, yeah, I'm feeling it. It
Well,
makes
Dilly,
me
you've
want
been
to grab a White Claw right now, though.
Dilly, I need some help. You're not pulling your weight.
Mm,
I need from you. You need to be music director. Okay,
okay, I
like
can do that.
this is the hardest part of these spaces. Actually, as you know, is coming up with the music. So like for you, it's
Mm-hmm.
easy. You
Yeah,
exist, therefore you know. Of me, I
I'll be
struggle,
DJ
and
Dilly.
yeah, and I so want to escape this boomer label. Like I really need your help. I really need your help.
So Pitbull was
I
your
don't
way of
know. I
escaping
don't
the
know.
boomer label.
I would just look at like dance tunes and stuff, and I don't know.
It got me dancing. I
I
was like
always like the
feeling it.
energy in that one.
Hmm.
Actually, I don't want to blame it on Danny, but I take full credit or blame for the selection of that song.
I love it.
So we're back. We're
We're
back.
back.
We're back. Dilly, does the world have things just seem really slow and quiet to you like the
No,
last week?
not at
No.
all. If you've
What's
been
going on?
sitting on Twitter, I think the world, this timeline that we're viewing is insane. Did
What
you
do you
know that
mean?
Linda stepped down from from
Yeah,
X
what
today?
happened? There was some anti-Semitic craziness that went off. I just saw the article. I saw the headline. What happened?
She didn't say why she stepped down, like if it was in relation to Grok or not, but I mean the timing. Hmm.
Yeah,
I
I
put
heard. Yeah,
I
did I understand correctly? Grok went crazy on some anti-Semitic stuff or something.
Oh yeah, George, like real crazy, like very hard into the paint. Grok went. But yeah, Grok. I think the most entertaining outcome could be for Elon to appoint Grok as the new CEO of X. Like that is what I'm hoping for. So
And what is the deal with? I mean, this is all stage theater, I know, but I saw this craziness. I get brain rot from trying to understand this stuff.
yeah,
But Elon Musk was going after Dan Ives yesterday. I couldn't
yeah,
understand what
he
that
told
was
him
all.
to shut up, I think.
But Dan Ives was saying he should get paid more money and all this sort of stuff. Why did he go after him? I didn't understand this.
'Cause I don't think Elon likes any cooks in the kitchen. Like I don't think he wants to share.
I don't know. I think with Musk, it's like the Trump strategy towards publicity. All publicity is good publicity,
Oh
whether
yeah.
whether it's criticizing him or praising him. He just likes the people talking about him. And
Oh
I
yeah.
still have a hard time. I notice here, I'm saying this in an affectionate teasing way. You're referring to him as Elon. I hate when people do that.
Oh, I'm
Okay.
sorry.
I hate when people do that. People don't talk about Donald Trump. They don't say Donald. They don't when they talk about Richard Nixon, they don't say Richard. When they talk about George Bush, they don't say
Yeah, but
George.
I think I say Elon Musk because I don't want him to be like like any more famous than what he is. So if we're just gonna
Well,
call him by a singular name, like
that's
that's
okay
just
for you. But you know what? I'm going to use that actually as a transition to get Danny in here. Danny, welcome. Good to see you, my friend. Danny, please unmute yourself.
welcome, Danny, to the belly of the
Danny,
beast.
if you
Maybe
can hear it, there you
Hey,
go.
there he is.
Can you
hey.
hear us?
I don't know if I can beat that intro, but thanks.
All right. Okay. So, Danny, the first question. The first question. You did not prepare for this. Why do people refer to Elon Musk as Elon? Like usually when you call someone by the first name, it suggests a certain degree of familiarity. In like Michael Jordan, it's Michael. Okay, or LeBron James, it's LeBron. Like what the hell? I mean, no one calls Donald Trump. Certainly, no liberals call Donald Trump Donald. So, how would you describe, or to what do you did you? Why would you suggest that people refer to others that have no idea who they are? They have they have no personal relationship with them, yet they refer to them by their first name. What is your theory behind that?
I just don't think Musk would have the same, kind of impact. Just saying,
Yeah.
"Oh, Musk did this, Musk did that." No, I think it's way smoother with Elon. I think it's just actually the sound of it more than anything.
Yeah,
Elon.
Musk doesn't really like pack a punch. It's like weird to say.
Yeah, but Dilly, if we were going to talk about, say, like a really bad dude, like say, Adolf Hitler, all right?
Hmm.
Danny wouldn't say, "Oh, Adolf. Adolf did this. Adolf did that." You wouldn't say Adolf. But yet we say Elon. But yet we say Elon. So
But
Danny, what say you?
it sounds smoother to say Hitler than it does to say Adolf. It
Yes.
sounds smoother to say Trump than it does to say Donald. So I think it's as simple as that.
You don't think it's meant to suggest any term of endearment or anything like that? It's just easier. It sounds
Yeah,
better.
I just think it sounds easier. It sounds cleaner. That's all.
Yeah, but
All
that's
right.
not to say there isn't like people idolizing these guys. So
Sure.
I think it's not like one or the other.
I got it. I got it. All right. So Danny, welcome. First time we're together in a space. I think we're simpatico. We've been long time followers of each other. Thank you for sharing with me some of your research and preparation for this session. You've been on quite a roll. So let's go right from the frying pan into the fire. I deliberately, for everyone who may not be aware of this, like I did not make up this title. And Van Drunkenmiller, I did not steal it from you. Drunk Fiscal and Mega Easy Financial Conditions. That comes from one of Danny's recent missives. And then I put in, and now we're going to get rate cuts? Like, what the heck? So, Danny, let's start with that sort of triggering headline title. Maybe explain to the audience, what you meant by that. Where's your head? Where do you think we're going? And then we'll get into what it means for markets and, what an individual investor should do about all this. So, Danny, the floor is yours.
Sure. I wrote a note with a cleaner title, which is "The Crisis to Come." Basically, everything I see is leading to inflation. Every which way I look at it, obviously the fiscal deficit just continues to be extremely large. The fiscal impulse, which was supposed to be, neutral or negative this year, is now positive. It's very positive next year. So they're just spending wartime spending in a period of full employment. Just absolutely astonishing that they keep doing this. But financial conditions have also eased substantially since that shock in early April. And this is also supportive of growth. When I look at all the forces of inflation, and I'll caveat, I cannot pinpoint exactly when inflation will hit. Inflation is the hardest thing to predict or forecast. But every sort of impulse I see is pointing towards us having another big, surge in inflation, not to 9%, but to uncomfortable levels. One is easy financial conditions. I think one of the things, obviously, everyone is familiar with is how equities impact the wealth of households, and we've had a sharp rise up in equities since the low in early April. But the dollar, I think, is the most important and misunderstood aspect of this. And the dollar has unwound the entire 2022 tightening in a span of 4 months. And the dollar does a few things. One, when it weakens, it increases S&P revenues for international companies that have sales abroad. It increases liquidity in the financial system. Obviously, that supports risk assets as well. But it also raises inflation directly via import prices. And we have a 10% decline in the dollar since in the last few months. This should imply something like 1.5% increase in inflation over a 6 to 12 month horizon. Very hard to time it, but that's in the pipeline. So from financial conditions, very, very easy. The money supply is growing. Now, this is not a huge impulse, but it is growing faster than it was growing last year. And, that's a concern that maybe consumers will turn around and borrow more or businesses will borrow more. If we get a credit expansion, that's a very big impulse. Right now, it's a small positive impulse. The attacks on the Fed, I think actually this is the biggest macro risk that I see is the attacks on the Fed independence. Um, they're forcing the Fed to be more dovish than otherwise. We don't know if Powell will be able to hold the line or not hold the line, but you have members of the Fed that are already super dovish. You have obviously the potential. Well, I wouldn't even say potential. It's effectively a guarantee at this point that Trump is going to appoint someone who has no regard for the economic situation and just cut rates just for the sake of it or to reduce interest expenses. Um, this is historically an emerging market story. This is not historically a developed market story, and this is likely to raise inflation as well without any benefit to growth. We obviously have seen all the corporate surveys saying that their input costs are coming up and they plan on passing this through. So it's coming from the corporate sector. The household sector, inflation expectations are unanchored. They're above 5% in a 1 year horizon. We don't know how they'll respond to this, and so we have all of these dynamics pointing towards inflation, and yet we're constantly talking about rate cuts. We're constantly talking about reducing the policy rate for an imaginary weakness in the economy that just doesn't ever seem to materialize. The labor market again proved that it's more resilient last week than people give it credit for. And so I think it's a very concerning picture, over the medium term horizon. And in particular, I would say the attacks on the Fed independence is the biggest risk for it all.
Danny, very well said. So let's dive in. The way you lay it out, and I agree with virtually everything you said, doesn't it almost guarantee a crisis? I know you wrote in a recent piece, "The Crisis to Come." It's because it's this sort of circular logic where they're just going to keep doing it and doing it and doing it until they can't do it anymore. It's like a basketball. Keep running the same play until the defense stops you, right? So if you didn't know any better, you'd think that, hey, you know what? MMT's fine. Look, no problem. We can spend as much money as we want. Look, what are you worried about, Danny? No problem, right? So it's kind of like they're not going to change course. And it's not, I don't mean to make a political thing. It's not a Republican thing. It's not a Democrat thing. Nobody ever takes their foot off the accelerator on the spending. And as long as the bond market vigilantes are, on vacation, I mean, they're just going to keep pulling this stuff. So doesn't it tell you, certainly suggests to me that they're going to, that they're going to bring on a crisis of some sort?
Absolutely. I mean, I think it'll be one of the most difficult crises to manage because in every crisis that we've had, historically, if you go back decades, the answer was the answer was to throw money at the problem, right? In '98, Asia financial crisis, we had a wobble in the equity market. They cut 3 times. In 2001, they cut 650 basis points. In 2008, they cut 500 basis points. Did QE. 2020, they threw the kitchen sink at the problem. The issue with this is that's the incorrect medicine. Now, the tariffs will actually cause, some sort of stagflationary response, which means growth will be somewhat weaker than it was before tariffs were in play, and inflation will be somewhat higher than when tariffs before tariffs were in play. And yet, the correct medicine is not to cut rates in response to that weakness because of what it'll do to inflation. And so it just seems to me that there's no appetite from either the monetary authorities or the fiscal authorities to deal with this. I think it's very, very risky and dangerous, and it is likely to cause a crisis. And when you have undermining of the Fed's independence and complete disregard for the economic situation, you're going to lose some of the dynamism of what's made the U.S. economy the crown jewel of the world, and so I think it's a very, very scary picture. Even though today or the initial phases of it will feel wonderful because risk assets will go up, equities will go up, everyone will feel happy until at some point when the inflation story is just so bad that it'll all fall apart. But it's hard to
Uh,
that is.
y- yeah, so Danny, you're talking about emerging markets. So if we were dealing with a fictional country, Bankruptistan, and Bankruptistan has a collapsing currency and yields are going up and all this sort of stuff, and they go to the IMF, and the head of the IMF, Danny Dayan, says, "Okay, this is what we do. This is the playbook. You cut spending, you raise rates, blah 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 blah." As you said, what we're doing now is completely antithetical to that type of prescription.
That's right. So you nailed it. Like, Brazil, Argentina, Turkey, all these countries have undermined the independence of the central bank. What has tends to happen is the currency will weaken sharply. That raises inflation. And at some point, they need to hike rates aggressively to regain control of the currency. This actually is not something we typically see in a developed economy. Certainly not in the reserve economy, the reserve currency economy. But it did happen once in the 1970s. In 1979, I call this the doom loop. And effectively, inflation, as we know, Arthur Burns didn't solve the problem. He didn't finish the job. Inflation was coming back, and the Fed was telling everyone, we can solve this, but we're choosing not to because they don't want to crush employment. Inflation expectations started to get unanchored, similar to today. And as the currency kept weakening, they kept trying all these different things. They tried to use gold, they tried to, other things, but it just made it worse and worse. And at some point, the only answer is to hike rates far more aggressively than you needed to at the beginning of the episode. And at some point, the solution is to hike rates to the point where foreign investors say, I can't, be anywhere else other than in US dollars because the rate is so high relative to the rest of the world that, I need to be in dollars, or I need to be in US treasuries because they're so appealing now, and so on and so forth. But we're completely ignoring this potential. In fact, even Powell, last week, he had, a public speaking engagement, and they asked him, sorry, it was at Congress, and they asked him in Congress about the dollar. And he said, we're not thinking about the dollar. It's not our job to think about the dollar. And I think the dollar is the constraint. And, we could be at the early phases of them losing control of the dollar. And the only way you regain it is with a Volcker response. And so,
So, yeah, so Danny, let's talk about the appropriateness or inappropriateness of cutting or thinking about cutting rates right now. I'm with you, but I read some of this stuff. It's like they live in another world. They do stuff like, oh, if we take the price of eggs over the last 36 hours and we annualize them, or if we take the price of crude in the last 24 hours and annualize that. I mean, they're making up this narrative about inflation's going down, and then you have some of these blowhards going on about owner's equivalent rent and blah blah blah, and like I have to take the page and turn it upside down to understand what they're to even make it look like it's plausible what they're talking about. So could you just speak a little bit, because I know you've put out in some of your research about your inflation outlook here, and why the falling and how the falling dollar and the tariffs are going to impact inflation. And the other thing too, I'll just say, just as a little pile on, I just can't stand these people the way they say this. Well, the tariff increases, they haven't really affected the economy. Everything looks great. Well, yeah, we haven't even started them yet. And then they say, well, it's really not going to do anything to inflation. It's all going to be about growth and blah 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 blah. I mean, Danny, where do I buy this Kool-Aid? I mean, this is just complete insanity to me. So, could you talk about where inflation is, where you think it's headed in respect of the fact that, employment is, we're still pretty much at full employment. We got tariffs coming. We even got oil prices picking up. We got the dollar down. So, let's talk about going forward. Forget about where it has been, but where you think inflation is going.
yeah, I mean, we're a bit above target for 4.5 years, and we have this sort of seasonal element to inflation, which is exactly what the White House is pointing to. So there's this period where inflation tends to be hotter in the beginning of the year, and then in the middle of the year, you tend to have a few months of cooler inflation. There's a reason why the Fed says look at year over year or 1 year, average
Sure. Yep.
inflation, because you're supposed to, these things will equalize each other over time, or offset each other, I should say. And, we have the White House coming out and saying, look, they just chose the perfect 3 months to point to say that there's no inflation. In 2018, it took 3 months for any specific category, like washing machines or whatnot, to hit its inflation categories. I mean, there's all kinds of dynamics in inflation that it is not a real time measure at all. Everyone knows the shelter story, that we still have a significant amount of rent increases that haven't hit CPI yet, and there's catch up there. But, here's another example. Used car prices went up 2.7% in April. And in April and May CPI, it was negative. So it still hasn't hit the data, right?
Mm.
So there's all these forces like this, and to think that you can just pick a specific 3-month period and say, oh, let's ignore, that the ISM surveys or the PMI surveys are, effectively saying they see 5% type of inflation coming. Let's ignore inflation expectations, which are the highest in 40 years, and show 5 or 6% inflation. Let's ignore, easy financial conditions and things like that, and let's just, cut rates for the sake of it. I think it's been very, very reckless. So here's how I look at it: the dollar weakness thus far is about a 1.5% impulse over a 6 to 12 month. Now that's a cumulative. It's not like it's going to hit all in 1 month or something like that. But the dollar selling off will raise import prices, and that will feed into inflation. It's roughly a 15 or 20% pass through historically. The tariffs obviously will raise prices, and there's a huge debate on whether that'll be, a transitory one-time price shock or a persistent shock. I'm in the persistent camp. I'm probably the only person who says this, but first of all, in order for transitory to even be true, first you need to have that inflation. Then you get consumers say, no, I'm not spending anymore. And then you get the transitory, right? So the fact that people are saying cut rates now based on a hypothetical argument of it being transitory, you're skipping the sequence. First, consumers need to feel the weight of that inflation to then respond by pulling back spending. And so these arguments don't hold water, just on the sequence of it. But my argument is that when we were originally told what tariffs would be, when Trump was campaigning, what the original argument for them was that trade terms are unfair to the United States. Country X, let's just say Europe, has higher tariffs on U.S. exports than the U.S. has on Europe's exports. And so it's unfair, and we want to equalize these relationships. The thinking was you would use trade terms or tariffs as a sort of way to induce a negotiation where we eventually get to a fair playing field of zero. That was, if that were to happen, I agree it would be transitory because tariffs would raise prices for a few months. Europe and the US and all the other countries come to agreements to reduce tariffs to zero. Okay, well, then those price increases should, in theory, go away. But what they've done is instead say we're going to have an effective minimum tariff level that is very high, 10%, and probably higher than that, where we're looking at 15 to 18% effective tariff rate when you include all the ways they're above that 10% with various countries and various categories, sectoral categories. That is a permanent transformation of the supply side of the economy. It's effectively like Brexit, right? So Brexit was a supply shock. A supply shock, most people say by definition, is transitory. But when you have a supply shock of that magnitude that's permanent, what happens is you reduce the productive capacity of the economy. You reduce, manufacturing productivity in a sort of permanent way, and ultimately you have also improved the pricing power by reducing competition of the businesses in the economy, which is getting them to raise prices. And so this is a more permanent shock than I think people
Right.
appreciate. And if you look at Brexit, the result of Brexit has been a permanent reduction in the investment rate of the economy, higher wages, and higher inflation. You saw that even before COVID hit, and weaker real growth. Not a good thing. It's a stagflationary shock, but that has been persistent. It's a structural change to the economy. I think it's a bad one with trade wars. And, so in my opinion, I think it's just bad policy. But on top of it, they're trying to gaslight the public, in my opinion, the White House, by, ignoring the impacts from their policy, saying,
Yeah, and Danny, let me interrupt to give you a rest. I could not agree with you more. And what I find so offensive is some of the biggest names on Twitter who shall remain nameless with some of the biggest account follows. These are arrogant blowhards who will, like I said, they'll annualize 2 week numbers. They were wrong in 2022 about transitory. How they're not sufficiently embarrassed to even come back, stay in the public eye, and again use that word transitory as if they learned nothing. I just want to like bang my head against the wall. I don't understand it.
All these people, George, are they're always the same calls over and over and over again. It's not like they just came to this conclusion and say it now. They've been saying, Fed funds rate is too high, neutral rate is lower, we need to cut rates
Yep.
aggressively, or the economy is going to fall apart. They're always preemptive,
Yep.
imagining weakness that never
Yep.
real life.
Yep. And they totally missed the rise in inflation in 2022.
Yeah.
They were totally wrong on the bond market. They attempt now 3 years later to want to take a victory lap because inflation's come back down to the the crazy levels it rose to in 2022. They're just completely wrong, but they learn nothing. They learn absolutely nothing. To me, it's just mind-boggling. Danny, let's take it one step further. Okay, so that's inflation. Okay, fine, but now let's talk about interest rates. Uh, Michael Howe, I think we all have a lot of time for, has been in the vanguard. Talking about term structure and term premium and so on and so forth. And so, regardless of where you think inflation is, whether you think it's 2%, which I don't, or it's 3%, or it's 4%, the idea of lending money to the US government for 10 years at 4.4%, if you're not clinically brain dead, if you have a pulse, just makes absolutely no sense. Now, I get we may get yield curve control. I get then may get some financial repression. I get they may induce the banks to buy all these bonds. But in terms of those who don't have to buy our bonds, speak, as you mentioned earlier, foreign investors, you know, especially given the burgeoning and intensifying policy instability we have here. Like, I don't get it. I mean, to me, look, I don't know what's going to happen to bond yields. Nobody really knows, but I think bond yields go down from here. It's for the wrong reasons because we have a freaking depression. All right. So everyone wants their, 2024 back. They want their Goldilocks. They want their slow growth. They want their low yields, yada, yada, yada. You can't have both. And so I don't know. I'm not going to hold you to it, but I'm just really more trying to calibrate your degree of bearishness on interest rates and bond yields. So talk to me a little bit about where you think interest rates and bond yields could go.
Right. I think there is a risk of what the White House is talking about doing, which is what's kept macro funds and the vigilantes from shorting it aggressively lately. But I'll come to that in a second. First, you're right. I mean, I think it's a poor deal to buy bonds at these yields. In particular, look, the equity market offers a substitute, and you can see that the last 2 months the equity market went up 5% each month. So you're talking about the yield for an entire year that you can get in 1 month if equities have a good run. Uh, it's not appealing on a cross asset basis relative to what equities return in particular, especially when you have these deficits and easy financial conditions. Foreigners have stepped away. Not only have they stepped away because of the concerns you raised, but also currency hedging is very expensive. And currency hedging in particular is now very important. For 10 years, you had the ability for foreigners to buy US assets unhedged. And not only did you earn the return on the asset, but you made an additional return from the currency strengthening. And so translating that back to your home market was a very good deal. Now, obviously, the dollar has a risk to it, and they need to hedge any sort of US assets they have. It's very expensive. If you look at 10-year yields converted to, JPY or converted to euro terms, they're far lower than what those domestic bonds yield when you include those hedges. And so it's not very appealing for foreigners. You also have an adversarial White House relative to a lot of countries that used to buy our debt. Um, you know, China and Russia certainly have no desire to buy the debt, but even allies, Japan, all these other countries, why should they be buying the debt when you're, effectively hurting their economy voluntarily? You have persistent deficits and supply, growing, infinitely, and you have, frankly, inflation that has been sticky and elevated for 4.5 years. So the term premium is still very depressed. I think a fair value for it should be 100 to 150 basis points, which would put you around 5.5% on the 10-year. And I think that would be a much more reasonable, fair level. Now, why hasn't that happened? I think there's a couple reasons. One is the nature of the hedge fund industry has changed. And, so you don't have the George Soroses and the Bruce Kovners and these guys, who can have a long leash with their risk taking and say, I know this is going to happen over 12 months. I can deal with, 30 basis points in my face for what I think is 200 basis points in a year. They don't. There's no ability to do that if you work at the multi-strat hedge funds. You have very short leash on your risk taking. If the trade goes against you in one day, you're probably taking it off that day. So that's one thing, the structure of the industry, but also this sort of rumors that they're going to do really crazy radical things to get interest rates down, putting in, effectively a Trump loyalist into the Fed chair to slash rates for whatever reason that he wants, just to reduce interest expense. He's talking 300 bips lower is where he thinks rates should be. So just imagining someone doing that. And then secondly is, maybe they're going to change issuance. Are they going to change issuance to have no long-term bonds at all and only be T-bills? You would think rational heads would say no, but this is not a rational administration. So I think that's preventing the bond market from really violently going. And it'll take the data to really push us there. So if we start to get some hotter CPI prints, you'll see higher yields. But for just imagining those, I don't think the market is ready to have a violent move until it sees the consequences of these policy choices.
As the saying goes, Danny, what could possibly go wrong? I mean, listening to you talk, again, to use the oft overused phrase, bastardization. I did this, adopted this years ago. They used to always talk about the risk-free return, the return on government instruments. Well, to me, equities look like return-free risk. I mean, I just don't see, given where estimates are going, given where bond yields are going, and probably multiples with it. I mean, it ineluctably leads me to the conclusion that, equities are on borrowed time. But I mean, trying to time these things next to impossible. So translating that into how one should invest. Clearly, you don't like bonds. Where does it leave you thinking about equities generally, or commodities, or certain sectors in the market? Or if you don't know what to buy, what would you avoid?
Yeah, I mean, I think equities are going to continue melting up because of these policy choices. Are just
Hmm.
they're giving you no choice. I mean, there's no fundamental basis in the market. It's liquidity, easy conditions. And the fact is, I'm more constructive on growth than the consensus. Uh,
Okay.
I don't think that we're near a recession. I think we're going to chug along. I think it's important to understand that we're not going to grow like we did the last 2 years because of the lack of immigration has changed the economy in a way that the growth rate will no longer be what it was the last 2 years. And I think what people view as slowing is really
Hmm.
just the change in the size of the labor force from immigration. So I think that's one thing that leaves me more optimistic on growth than most people, is just understanding this. But when you're talking about, we're going to do policies that crush the dollar, well, the dollar weakening is generally good for equities. When you keep rates lower than where they should be, that's good for equities, right? Inflation initially, as long as it doesn't get too high, is good for corporate revenues. As long as they're able to pass that on, sales will increase. So equities still look like a good bet. I call it like the 1999 playbook, where financial conditions in 98 you had the Asia financial crisis. You had 3 rate cuts that they didn't need to do. We got 4 last year that we didn't need to do. And as a result, financial conditions, really went turbo easy, and the market melted up until the point where the Fed got concerned about it. We're not seeing the Fed concerned about financial conditions. We're not seeing them concerned about equities, the dollar. So we don't have the grown up to say, hey, this has gone a little bit too far. And as long as that's the case, I think equities keep going. And I do like commodities. I think you have to pick and choose. I trade around. I don't have like one specific commodity that I'm long at all times. But I think we've clearly seen a good run up in gold and silver. I think copper has a big run ahead of it. Has already had a big run as it did yesterday and the last few weeks. But I think it has a huge run coming, over the next couple of years. We've seen other commodities like palladium and platinum. They've all gone, very, very sharply higher. It's all tied to loose conditions, weaker dollar, and frankly, growth just being better than people expect.
Got it. All right. It's been a real tour de force. So, anyone has a question, please raise your hand. Otherwise, you're going to be stuck with me continuing to ask questions. Hey, drunk, are you out of your stupor, or you're up? It's kind of early for you. What's going on, drunk?
Uh, I had to get in and do a little bit of research, but I did have some memories of that 97, 98 period. If you want to hear my current feelings about the dollar.
Yeah, drunk. Please. I mean, by the way, I've never seen you up this early. Kudos to you. You can make this a new habit.
We'll see how much stock I can get in one of the energy drink companies and see if that gets it going. But I wanted to tell you about the time that I knew the dollar was going to crater. Just like now. I was so confident that I started converting my bar tabs into euros just to get ahead of it. This was back when everyone was still pretending that the twin deficits didn't matter. It was like late, maybe 97. Greenspan was still whispering sweet nothings to the bond market, and the Asian financial crisis was lighting up currencies like a margarita blender at a hedge fund retreat. I just finished reading half of a research note before spilling bourbon on the rest of it, so I didn't get to finish it. But without the academics, I know an imbalance when I see it, especially when it's on my credit card bill for my ex's trips to Bloomingdale's. So, I kind of said to myself, this is your moment. This is when the dollar dies and your liver goes with it. So the twin deficits were widening, trade partners were sneezing, and the U.S. is acting like it had just discovered infinite leverage. So I called it the tequila sunrise signal.
There
When
you go.
America gets hammered, it exports that hangover. So my analysis was airtight. America spends too much. The world loses faith. The dollar drops harder than my standards after midnight. So I decided to go long everything that wasn't the dollar. Now you may remember famously that Stan made some money shorting the Thai baht.
Yep.
But me, no, I went long the yen. Sure. Euro, sure. Why not? Norwegian krona, sure. It seemed exotic. Swiss franc felt classy. I even tried to long sturgeon caviar futures, but ended up wiring money to some guy named Yuri in Belarus, and I haven't heard back from him. So I bought some Icelandic bonds before I realized they weren't actually a rock band. But my crown jewel was the gold miners in Peru, right? So just like now, I figured if the dollar is going down, gold's going up, and I wanted leverage. The only problem was I forgot to check if the mine still existed. So
Small
turns out it
detail.
was yes. Turns out it was flooded in 1991 and repurposed as a llama sanctuary. But in a twist of fate, my assistant told me we didn't actually play that. Somehow I accidentally shorted gold miners because I thought they were overvalued in a blackout rant, and my assistant was too scared to tell me. So,
Oh
with the
God.
plot twist, they weren't actually miners. They were a Bolivian copper play run through some guy named Pepe, but he now runs a juice stand in Miami, and I don't know where my money went. So, technically, I was directionally correct. The drop did happen eventually. Unfortunately, I was liquidated emotionally and financially about 3 weeks before the move. I got stopped out because I hadn't hedged the trade with some Australian bank stock I thought was a gold ETF. Turns out it was just a credit union that lent money to surfers. So
Oh God.
the
So
moral of the story, George, though, is that
yeah,
the dollar did fall. I just didn't live long enough to enjoy the trade.
got
So
it.
it
Yeah,
felt
but yeah,
right.
yeah, but Van, second time's a charm. So you think Danny's right here?
Yeah, I'm just going to try not to puke on my trading terminal. I'll say this. I don't regret that trade. I see sort of the same setup now. Sometimes you don't need to be early or right. You just need to be confident and drunk enough to retell the story like it
Yep.
worked.
Have a hunch, buy a bunch.
Yep.
Exactly. Exactly. So Van, just hang right there. We got Deer Point, and I think he's a little more sober than you are. So, Deer Point, thoughts, comments, reactions about Van or Danny?
I mean, no, Ben, I think summed it up. But no, I mean, I tend to kind of echo Danny's thoughts here.
Yeah, and Deer, you also frequently, I know you look at intercurrency relationships, cross currency basis swaps, all that kind of stuff. And so
Don't tempt me with a good time, George.
I know. So all right, so you have to complete the response without using the term cross currency basis swap. So let's just kind of like running around your backhand. So so let's do it a different way. It looks to me like we're not. If you're a foreign investor, the U.S. isn't exactly opening you with extending you a gold plate invitation to put your money here. So the way the foreigners look at the U.S. now, like you agree with Danny that it's going to be they're probably less interested to invest here than more interested. I mean, basically scaring the foreign investor away. I think. Or what's your take on that?
No, I mean, I would tend to agree with that. I mean, I just got done doing some work essentially looking at foreign investors' exposures to U.S. Asset markets, so like equities as well as bonds, et cetera, and kind of as Danny highlighted, just with where hedging costs have become, and just how high they are, even though they've started to come down a bit. I think that that's just led to a lot of people essentially keeping capital domestic. And I mean, you've seen it with even with U.S. domiciled companies, right? Like a lot of U.S. domiciled companies have started issuing something called reverse Yankees, which is just issuing debt denominated in euros, even though they're U.S. domiciled, and those volumes have picked up pretty
Well, yeah,
tremendously.
dear, hold on. U.S. companies issuing bonds in euros. They're called reverse Yankees. You learn something new every day.
Yep.
Is that what you? Okay, so hold on a second. If you're a U.S. guy and U.S. entity, why would you borrow money in euros if you thought the euro was going to go up?
Cheaper funding.
So cheaper funding, but that's the old cheaper funding, but the value of your liability may go up. Like that, I don't know. I
Yep.
mean, well, how cheaper is it if you're one of these U.S. guys, corporates that's doing this? How much cheaper yield are you getting if you borrow in euros, say, just roughly, as
It's
opposed to
2%.
dollars?
The policy rate in Europe is 2%. And then if you hedge the currency, then you're not worried about the euro strengthening, right? Because if the euro strengthens, you've hedged that risk, but
Right.
you've funded yourself at 2% rather relative to the Fed funds rate in the US at 4.5%.
So okay, so you can hedge away the currency risk, and you're net much better off borrowing in euros than you are in dollars, if I understand you correctly. Is that what you're saying?
I haven't seen all the data that Dear Point is referring to, but I'm just speaking about the funding rate is it is 2%. It's
Mm-hmm.
lower in Europe, and so
Yep.
I think what the real reason you're seeing those trades, if I'm just guessing here, is not necessarily all about the funding, it's about the demand. And we're seeing demand for non-USD bonds,
Ah,
rise relative to USD bonds due to the currency risk of the dollar, weakening pretty significantly. If they put in, a Trump guy to be the head of the Fed, and they're going to cut rates just for the purpose of funding the deficit that they just created. The tax cut bill blows up the deficit, and they're going to cut rates just to accommodate that, not because economic conditions warrant it. What we've seen with the dollar is nothing compared to what we will see at that point.
yeah,
We will see like a 20% collapse in the dollar very, very fast. And so, if a lot of foreign investors, well, in particular, if you're a European pension fund, do you want to buy more US dollar denominated debt, or would you rather a US company that you like investing in issue a European denominated bond where you no longer have that currency risk? I think that's what we're seeing. Deer Point can, add his opinion, but I think what we're seeing is for investors, they are heavily exposed to US equities, US bonds, and US corporate bonds and US treasuries, way more than they never thought this would be a risk, and they're now learning that it's a risk to be this allocated. It doesn't mean they have to dump what they have. We did see a little bit of that in April, but it's still the United States. You don't need to dump everything like this is Argentina, but
sure.
you do need to be cognizant for going forward. Maybe we should invest less, and I think that's what we're seeing.
Makes sense. Oh, dear, you got any comment to add to that, or are you good?
No, I mean, I think as Danny mentioned, yeah, if you're unhedged, then you're kind of exposed to currency movements. But if you're hedged, then no. And I mean, I can't mention the cross currency basis, but I'm gonna break ranks here and do it. But I mean that's essentially what you've seen, right? Like, I mean, that's been
Right.
a big fact of why, if you look at Euro USD or even what you've seen with JPY USD and the tightening, it lowers the cost of swapping euro proceeds back into dollars, and that makes
Mm-hmm.
issuing euro denominated debt more economically attractive for companies within the United States. And now the same with Japan. You've seen a massive increase in samurai bonds. I mean, massive being relative here, but I mean, all of these things are starting to tick up.
Interesting. Dilly, fascinating, no?
Truly.
Oh God, curb your enthusiasm, Dilly. Um, so, Danny, talk about. I mean, this timing thing. It's trade tariff thing. It's a national sport. I mean, every day it changes. Story changes. Trump changes his mind. Nobody knows what's really going on. But let's assume hypothetically that it comes in somewhere. I don't know what people are saying. 10%, 15%, whatever it is. Plug in whatever number you want. 10% across the board. China gets 30. Whatever numbers they talk about. There's this ongoing parlor game trying to debate, how much do companies raise prices? How much could companies not raise prices? Consumer spending gets hit. Like, could you parse that out a little bit and about how you think it's going to play out?
Yeah.
There's a little bit of both.
Yeah, I mean, well, first of all, we had this sort of taco narrative for the last few months where the only things that we were seeing were de-escalation. Now we're no longer seeing that. I think that's an important thing to notice, is that we're actually seeing some tariff rates set at April 2nd levels in a number of countries. The effective tariff rate is now looking to go up, probably to a 15 to 18% range, depending on where we land on things. And so that's a big step up. That alone should raise prices by about 1.5%, given imports and all that. In terms of the pass through, most companies are saying they're going to pass through almost all of it, 70 to 100% of it. But there's other things that I think, people are too complacent about this is, we know that tariffs affect goods. They do not affect services. Go look at the services prices paid. ISM services prices paid has surged just as much as the manufacturing one has. This tells you that services companies are looking at the environment and saying, if other companies are raising prices, I can do that too. And that's a much more concerning aspect, that this will be a bigger shock than people are prepared for. Is why would services companies be raising prices if they're not seeing that? There was a Wall Street Journal article with Barkin, Thomas Barkin, the Fed governor, who said he went around and talked to businesses. He goes in person. He's not just relying on surveys and whatnot. And he's asking them, why are you raising prices? And they're saying, because I can. Because I can. We're going to try it. If it doesn't work, we'll come back, but we're going to try it. And businesses were like, are your input costs going up? And they said, no. Why are you raising prices? Because my neighbor is, my competitor is. So we're seeing that sort of behavior. I like to say it this way. Everyone always says inflation is a monetary phenomenon. The first phase is always a monetary phenomenon. The second phase is a psychological phenomenon. And that's what we're seeing now. We're seeing that the behavior of inflation is ingrained in the business sector and in the consumer sector. And they both are, becoming more and more and more comfortable with raising prices and dealing with it. And that's just a psychological change where there were companies in 2018 with the tariffs then who decided, I can't pass on the costs because I'll lose market share. This cycle, they've learned that I may lose some volume of sales, but my revenue may increase if I calibrate this correctly. If I pass on costs, I'll lose some volume, but overall revenue will increase. And they've figured out this calculus, and they're doing it. So this should be about a 1 to 1.5%, inflation pop over the next, 3 to 6 months that we should see. If we're seeing secondary behavior like services prices go up and things of that nature, then it'll be a lot more persistent and a bigger shock. Of course, we also have the dollar shock. So I think all of these things, coupled with, financial conditions that already are very, very loose, even outside of the dollar. Today, this morning, we had a big surge in mortgage applications. It's not super exciting in and of itself, but it just tells you the dynamics that we had for the last couple of years, where anytime financial conditions loosen, we get a pop in housing activity because the 10-year yield is too low. That dynamic is still in play. So we have all of these factors, gearing up for some kind of hit that we're going to get, and the bond market is just very complacent about this, and the equity market is euphoric about it, and I understand that. As long as the bond market is complacent, the equity market will be euphoric, in my opinion.
Dude, you had your hand up, too. Did you want to
Yeah,
say
no,
something?
just a question for Danny on price increases. Danny, how much do you think, at least at the sector level, that's going to kind of depend on the elasticity of demand, right? So, like in industries where demand tends to be relatively elastic, do you think those price increases from tariffs are going to be able to flow through, or they're just going to have to eat that on margin, right? And that's kind of been what I've been debating is, areas in which have a decent amount of elasticity of demand. I don't think that they're going to be able to do the same amount of price gouging as, an industry that is relatively inelastic.
I think it's, a big giant experiment, and we're going to find out, but I'll give you some anecdotes about this. I think the first step is to raise prices. The second step is to see how consumers respond. It's entirely possible that the view people have, the consensus view, that demand destruction happens and then the consumer buckles and pulls away. It is possible it plays out that way, but you have to first raise prices to see that happen. So I think we will see a high pass through, and it's possible that pass through then goes down and is eaten by margins as businesses see some response. However, let me give you the best case study we have so far, which it's still early. Used cars had a huge price increase in April, 2.7%. Remember, they had been going down, pretty consistently for the last couple of years after the 2022 shock. They had a huge pop due to the surge in demand prior to tariffs even coming in play. We had front loading of cars. And then in after April, what we saw is in May and June, volumes of auto sales went down, which makes sense. So that's where you would say they've lost that pricing power and it was a one-time thing and it should go away. Well, what happened? June prices went up 1.6% in the Manheim index. So it looks to me like we're going to get this pass through, and we don't know how it plays out, but it looks to me like the pass through will be pretty high because the fact is, even with volume sales coming down, companies said we're going to raise prices, and the reason is that they don't have inventory of used cars. It's very low. So where I think that we could see a lower pass through is simply because some sectors have inventory of goods that they may have accumulated. As an example, pharmaceutical products were a big driver of the trade deficit surge. And, so it's entirely possible that, by bringing in pharmaceutical products from tax havens like Ireland and all this, where we bring in those pharmaceutical products, we may have a lot of inventory, maybe a year's worth of inventory for that sector. But for other sectors like apparel and for copper and for cars and all that, I don't believe we have the inventory where they will not be able to pass through. So I think we will see pass through. The response is uncertain, but when I look at you know the reason I think that the consumer is going to pay it and demand won't fall apart is we have a 4.2% unemployment rate. It's very, very tight. And the labor supply has gone, very, very small. We're only growing, the effective labor supply by 80,000 a month. By the end of the year, it might be 25,000 a month. And so if we keep printing jobs anywhere near what we did last Friday, the unemployment rate will be below 4% before long. And when that happens, wages will go up. So it's entirely possible the consumer from this dynamic of the labor market plus financial conditions where wealth has gone up 12% in 2 months, right? From all of these factors that the consumer is in better shape than people are giving them credit for. And, consumers can then turn around and say, hey, I need higher wages. The government just decided to make me poorer. I need higher wages, and if one worker goes to their boss and says, "Hey, I need higher wages because the cost of X went up," they're going to be told to f off. But if the entire economy does it, if everyone in the economy turns around and does it, then we have the wage price spiral. All of these are possibilities. It's hard to say exactly how it plays out, but I think first we will see very high pass through to answer your question.
Oh boy. So again, Mr. Dayan, for the record, explain why anyone in their right mind would buy a U.S. long bond.
I think you can trade it. I mean, I think you can trade it. I don't think you can. I don't think you should be long the dollar or long bonds for any material amount of time. They're going to destroy your purchasing power of these, and the yield that you're getting will be worse than the yield. The yield on paper that you're getting will be far worse. Sorry, the yield on paper looks far better than the yield you will actually get on an inflation-adjusted basis, and I don't believe it's a good deal at all. And on top of it, like we talked about earlier, the deficits are ridiculous, and they're the funny thing is the White House comes out and they claim this tax cut bill will reduce the deficit. They claim tariffs don't create inflation. They're just lying to you, and that's fine. They can do that for now. Eventually, reality will come and hit. But I don't believe you can own bonds at these yields. I mean, I think 5.5%, 6% you can own bonds. Here, I think you can tactically trade them. Like anything, yields can rally 20 bips and you can get out of your trade and you made some money. It's nice, but I don't think you can own them. I definitely do not think you can own them. And partly, look at equities. Why would you prefer bonds over equities here? I understand valuations are high, but the market is going to keep going as long as we have these policymaker decisions from both the Fed and the White House. So I'm a firm believer that bonds are way 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 too rich, in my opinion.
So Danny, I have a friend. He wants to know. He writes in, "I've made a lot of money owning gold and gold stocks. What should I do with my gold and gold stocks?"
Yeah, it's a tough call. I think the conditions for gold to continue going are still there, as Van Drunkenmiller said. I think the conditions are still there, but look, gold does this where it goes nowhere for a few months. It seems to be in one of those periods where it's gone nowhere for since April. Um, I think you can, if you're capable, you could short the dollar, which is a similar trade. If you're capable, you could also own copper. And personally, I think copper, when I look at the demand supply imbalance for copper, it's more obvious to me than for gold. Number one, we have the electrification, demand that for electric vehicles, things of that nature. We have demand for AI data centers. We have demand for we're going to need to rebuild the war zones that have been hit quite hard. We're going to need a ton of copper, and we don't really have the supply of it. And then now we're actually bifurcating the copper market to U.S. and rest of world inventories, and that makes it complicated as well. So I'm not saying buy it the day after a 10% pop, but I would say any pullback in copper, you should be buying copper. I think.
No, but Van likes to buy momentum. He likes squeezing people. Van, the fact that it went up so much, I don't know if it's for your if you fell into your drinking in Van, but Van, don't you usually chase strength, Van? I don't know where Van is. He's probably getting pounded.
Oh no, I'm sorry. I was googling. I heard a mention earlier about the taco trade, and I heard that the taco's back, right? So it's lunchtime. I'm about 3 mimosas deep, so I googled taco investing, and I started wiring some funds to a taco truck in East LA. But it wasn't. Turns out it wasn't carnitas. It was Trump always chickens out. I found out. So by the time I figured that out, somebody had already taken my money. The taco truck's been towed, and the cook's day trading Dogecoin, and I got a fleet of depreciating food carts and a vat of expired guacamole futures.
Oh God! But Van, are you taking pro? I know you kind of Scott called you the other week and you kind of knew what was going on, so he gave you the wink, wink. So you were pretty long the copper. So are you taking profits on the copper? Or are you doubling down here?
Well, I once I got the heads up, I started chasing the momentum, but I thought they meant literally. So I was gonna chase the food truck up Mulholland after it had pumped 80% in a week, but I tore my ACL, and so turns out that momentum isn't really a strategy. It's a life choice for poor decisions without trailing stops. So of course I'm gonna continue to like the play on copper. I did kind of wonder though, since they have removed some of the restrictions or regulations on EVs, especially in California, and those take about 4 times the amount of copper of a regular vehicle. Whether or not that ends up having a long term effect on on demand.
Oh God, yeah, I forgot about that one. So hold on. So Dilly, did you have a question for Danny about Bitcoin? Because like he hasn't said anything about Bitcoin, Dilly.
Yeah, Danny, what are your thoughts on Bitcoin?
I was famously a Bitcoin skeptic for a very long time.
But you're not anymore, huh?
No, when I saw what this administration was doing to legitimize it, to bring it into the financial system, I had to drop my prior bias. And my prior bias, I'll just give you a summary of it, is while Bitcoin has limited supply of 21 million coins, the crypto universe as a whole, which a lot of it is fungible for each other, is unlimited. And so what you see is when Bitcoin goes up a lot, you get a lot of copycat coins and, fart coin and whatever, vomit coin or whatever stupid coins come out, Trump coin, Melania coin, all this stuff. And that increases the supply of coins. And so that actually gave me an angle to create a model for it. So I'm not a buy and hold guy because I'm not a buy and hold guy on anything. I'm a trader. I don't buy and hold the S&P. I don't buy and hold anything. I trade where I see asymmetric return possibilities, and hopefully get things right doing so. But with Bitcoin, what I did was I created a model, and the model has been very, very good at predicting short-term movements over, let's say, up to 2 weeks. And right now, I ran the model as of yesterday. It gives me a fair value of 104K. I think we're a little bit rich, but it's not rich enough that we're at a signal to short it. But to me, it's clearly not something.
Hey, Danny, you got
Yep.
this new model? Maybe Dilly, you and I should start like a crypto newsletter. Like we can make all these trading coins.
George, you got to buy Bitcoin first. But Danny,
Yo,
George has changed his tune too about
I will
hey,
Bitcoin.
say,
So you
Danny,
can't
help
be
Danny.
an old dog new
Danny,
tricks.
help me a little bit here. Anyway, Dilly, I'm gonna rely on Danny just because that way I can not take responsibility for anything. I'll blame it on him. So Danny, we have this thing where I'm supposed to buy Bitcoin at some point. We're gonna make like a public spectacle out of this, like Jesus Christ being killed at the stake or whatever. So, but I've been holding on because I tell Dilly the day I buy a Bitcoin is the day it's gonna peak. But also, I I'm a Kmart shopper. Like I want to buy the pullback, but it's not pulling back. So, like if I buy it now,
That's
I know
because you get the price you deserve, George.
But Danny, here's my problem. I know if I buy it now, it's going to crash until he's going to get mad at me. Okay, I know if I don't buy it, it's going to keep going up or won't come down. So, Danny, what's a speculator supposed to do?
buy it in smaller size.
Oh,
DCAN,
oh
George.
God, I knew you were going to say that, Dilly.
That's what you got to do.
Dollar cost averaging, right? Dilly, let me ask you a question. Okay, you know what? I'm almost going
I
to do
will
this.
say this, George, just to kind of check.
Yeah.
Whenever I post about Bitcoin, it's usually some of my most popular posts. I don't
Yes.
so, and I'm not a regular Bitcoin commentator, but whenever I post my model, people are looking at it
Yeah,
very.
but Danny, okay, be honest, okay. Like you've done really well with your calls, but there are probably some you're not so good at. So, like, how could we use you as a contra? Like, what are like you always wrong on?
That's an interesting question. Um,
It's all right. Maybe you haven't stuck your neck out, but it's like, I guarantee you, Danny, if it gets an out, and if I in Dilly, if I submit to your desires and I buy Bitcoin, you're gonna tweet it out. It's gonna be everywhere. All right. And then they're all gonna laugh at me and they're all gonna say, oh, Noble's a contra, he's long Bitcoin, da 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 da, and then it'll collapse. And then Dilly, what are we gonna do?
I don't think it's going to collapse when you buy it. You're right. I am going to shout it from the
You're
rooftops.
gonna have your way with me,
Yeah, it will be
so to
the
speak.
best orange pill that I've ever done.
Well, maybe Danny, you know what? For our next space, you can come back with another coin. Doesn't have to be Bitcoin. There'll be some other coin, God knows. But yeah, no, this is Danny. Let me ask you a question. When you see all the, because like this is not your first rodeo, right? You're not as old as I am. Nobody's as old as I am, but you're not. It's not your first rodeo. When you look at some of this garbage that's going on, the SPACs, the Trump administration with their own coins, Dan Pompliano, what's his name, raising God knows how much money for the stupid crypto thing the other day. Dan Ives, blah blah blah. I mean, Danny, doesn't it kind of like make the hair stand up on your back and say to yourself, you know what? This is wrong. Like history's not going to look kindly on this stuff. And the problem is, there is a speech and a question here. The problem is, I think back on 99, 2000, and I got prematurely bearish and it just kept going on and on and on. And so, Danny, like when this is all said and done, you look back on it. I mean, this is the sort of stuff that they're going to write about in the history books, if you ask me, but maybe I'm too puritanical in that point of view. What would you say?
no, you're right. I mean, when I look at everything that's going on, it tells me clearly policy is not tight; it's loose, and I think everyone has this wrong. And part of the reason, and I think we have the response from the economy. when was the last rate hike? It was July 2023. We're 2 years later, and yes, they reduced rates by 100 bips, but nothing bad has happened. And I think the labor market, people thought that it loosened because of the Fed being at 5.5. No, it loosened because of the huge surge in immigration. And that and so when I look at everything, it looks to me like the Fed was moderately tight, but they were never really that tight. And clearly now today, by ignoring financial conditions, I see them as very loose. And the problem that I see, and the reason I always focus on financial conditions, is because it's a very monetizable framework. And the reason that it's so obvious is that we're always pricing rate cuts no matter what the story is, right? Like if inflation comes in hot, we're going to price less rate cuts, but we're still going to price rate cuts. Like it's ridiculous. We pass a huge fiscal package, we're pricing rate cuts. Equities go up 12% in 2 months, we're pricing rate cuts. At all times we were pricing rate cuts while they were hiking. While they were hiking 75 bips a clip, a year down the road, we were always pricing that they would turn around and
Yeah, and now that Arab we need rate cuts. I mean, I want to put my fist through the wall. Hey, Bitcoin Tina, you there, my
I am.
friend?
I
Weigh
just
in.
want to know how he models Bitcoin for valuation. I'm really curious. I'm not particularly good at that, and I'm very interested in what Danny has to say, if he's willing to share.
I have a proprietary model that I make money off it. I'm not going to share the gist of it, but if you sign up for my work, you'll see my updates.
Oh,
And
we can sign up for your. We can sign up for your work.
Yeah,
I
you can
didn't
sign up.
know that. Okay.
Yeah, I have a link in my bio. You can check it out. And then if you shoot me a message, I'll point you to the right note. It was from either January or February where I walk through the model. And then I update the model regularly every week. So
thank you very much. Thank you.
No problem. Well, George, just back to what you were asking.
Yeah, go ahead. Yep.
So when I look at, how easy conditions are, this is why I keep saying that we're in 1999 and that this is going to keep going until it blows up in their face and is obvious. And so if we had an independent Fed, which I think we're slowly losing that. If we had an independent Fed, I would be confident that within 6 months they would turn around and say we need to hike rates. Inflation is not getting better. It continues to be a problem. The mix between inflation and real growth as a result of tariffs is one that is no longer going to be appealing to a central bank. I think that mix is lower real growth than it should be and higher inflation than it should be on a sticky, persistent basis. Financial conditions are too easy. The equity market is at risk of turning into a dangerous bubble. Like you said, speculative behavior, the dollar, obviously, all of these things. I think that if we had a true, independent central bank within 6 months, the data will be so obvious that they will have to consider hiking. I don't know that this Fed can, frankly, turn around and do that given what the White House is doing. Here's a little conspiracy theory for you. Maybe Trump doesn't actually want 300 bips of rate cuts. Maybe all of this is to prevent the Fed from hiking. Maybe that's all it is, right? Maybe because I have to think Besant, Moran, Hassett, these guys are not dummies, and they have to know that tariffs are raising prices. They're capable of looking at the same things I'm looking at. They have to know that. They have to know that inflation expectations are unanchored. And maybe they're concerned that the Fed would turn around and say, like in 99, we need to nuke the economy. It's just not working. We need to nuke the economy. We need to prevent this bubble from, bursting in a big way, blah, blah, blah. And maybe they're getting ahead of it and saying, if we're so egregious and ridiculous in the other direction, calling for rate cuts, that the Fed won't have the balls or the stones to do it, to hike. Maybe. I can be somewhat sympathetic to that, but, and I don't necessarily think they need a hike today, to be clear to everyone on this call. But if my inflation outlook materializes, then I think within 6 months they probably would have to hike rates to end this inflation episode once and for all. But I don't know if Powell, in December, 5 months away from the end of his term, is going to be able to withstand the pressure from the White House and do that. And then I know for sure that whoever they put in next year is not going to take seriously inflation. Maybe if it's 6 or 7% and you have people protesting on the streets, then yes. But for 3 to 4%, I really doubt this White House is going to allow them to hike rates, and I don't think they'll be independent from the White House. So that's the issue that I see, and that's why I think these conditions are going to keep going until it's a crisis.
Well said. Before we go, I did want to mention everyone, we are having a conference, commercial message, on July 30, Stock Pickers Conference, unprecedented, 15 stock pickers, most of whom you know. This is going to be ideas oriented. It's not macro specific names. It's in my feed everywhere from Renault Solar, Renault Energy Fund, to Tom Chanos, Tom Thornton, Steve Kress from Seeking Alpha, Calvin Froge, Melody Wright, Motorhead, Jay Mintzmeyer, Gordon Johnson. It's all on my feed. It's going to be a fabulous conference. If you're looking for ideas, you can sign up in my feed as well. Danny, anything else you want to touch on before we close? This has really been fantastic. I hope you'll come back again before the year's over, but really learned a lot. And I don't know, Danny, I'm watching the bond market. I think that's the key to everything. But yeah, no, this has been great, Danny. I really want to thank you for your time.
Oh, thank you so much for having me. Appreciate people wanting to hear my crazy thoughts that come into my head.
Right. And they can find you on Substack, right? Not just your feed, but you have a Substack as well. Is that correct?
That's right. So you can check the link in my Twitter profile. From there, have a Substack. We also have a group chat that we run every day. It's pretty much the Wild West in there. If you want to be constantly entertained by the going ons of the day, come and join us in the chat, and reach out to me directly at any time.
So I'll come for the Substack, but I'll stay for the chat. Sounds like a great idea. All right, Danny, thank you so much. Deer Point, Van, Dilly, this is awesome. Dilly, I think our next space isn't until the 15th. Maybe there's the 15th and 16th next week. I know we have a couple spaces. We might add some others in between, but this has been great, Dilly. I really appreciate you. And maybe if we get a sale on Bitcoin, I'll edge into it. But
You're gonna get the price you deserve, George.
oh
That's how it works with Bitcoin.
God! All right. Thanks, everyone. Thanks, Jilly. Thanks, Danny. Take care. Bye, everyone. Bye.
Bye.